saver and investor is concerned about only his or her own capital and how that is protected from vagaries of inflation, poor economic policies, and protection for its future. And gold even now produces that 10% compounded return over a long period of time. Therefore, as we think about capital formation as a public goal, we have to be clear that there is a public policy requirement versus an investor who has a very different perspective, protection of his own long-term punji. That brings me to some of the issues that as we see the movement of the saver to the investor, it is the same person. Any of us, in a moment, take a decision, a bank deposit versus a debt mutual fund versus an equity share. So the individual changes in the mind from a saver to the investor. I'm asking the question that our system of regulation has compartmentalized the saver-borrower model primarily with one regulator and the investor-issuer model much more with the other regulator. So the saver is the same. The lens through which we are seeing the practitioners perform have different compartments, and what we have to be clear is that finally it is the same person which we are serving through different ends. And for sustained growth, we need to keep that. And the third angle, and I'm glad the Chief Economic Advisor was there, that in addition to the verticals on regulation, the third important player is the fiscal side. And as we build and nurture and build the guardrails of building a deep pool of capital markets which supports India's growth, as it has done for the last 40 to 50 years, into a new India with lower intermediation costs, there are some risks which we need to keep in mind. We have seen a phenomenal growth on the futures options, and I think a lot has been talked about that. And it reminds me of a famous, and this is not common, it's not about today, it's back in the 1940s, a statement of John Maynard Keynes, which went like this. Speculators may do no harm as bubbles on a steady stream of enterprise. The position becomes serious when enterprise becomes a bubble in the whirlpool of speculation. Therefore, what we need to keep in mind is the speculation is a core part of markets. But how do we ensure that the enterprise itself then starts manipulating things to get the speculation get to higher price? And this statement of John Maynard Keynes in the 40s, and it comes on the back of the Great Depression with the crash in 1929, is something which we always need to keep in mind as we think about balancing speculation with creation of capital formation and enterprise. And we have examples of that. I think the biggest example in recent times has been 1980 to 89 Japan. And it's only 35 years later that Japan index Nikkei has barely crossed its 1989 peak. And that's something which we need to keep in mind. But I want to at the same time say,
if you like this video, then like, share and subscribe to ET Now.